There are people you dismiss, and there are people you listen to, even when what they're saying sounds completely insane. Robert Kiyosaki is the second kind of person. The author of Rich Dad, Poor Dad, one of the best-selling financial books in history, with over 40 million copies sold worldwide, just doubled down on a prediction that is turning heads across Wall Street and Main Street alike. He says silver is going to $200 per ounce, not someday, not in a decade, this year, in 2026. Now here's the thing that most people forget when they hear a number like that and roll their eyes. This is the same man who told people to buy silver in 1965 when it cost pennies. The same man who predicted the 2008 financial crisis years before it happened. The same man who said Bitcoin would hit $100,000 when it was trading at $9,000. Was he early on some of these calls? Absolutely. Was he wrong about the direction? Almost never. So when Robert Kiyosaki says $200 silver, the real question is not whether he's crazy. The real question is, what does he know that most people don't? And that's exactly what we're going to break down today. Before we get into the $200 target, I think it's worth spending a moment on why Kiyosaki's opinions carry the weight that they do, because there are a lot of people making bold predictions about silver right now. What makes him different? Robert Kiyosaki published Rich Dad, Poor Dad in 1997. It became one of the best-selling personal finance books ever written, and its central message was revolutionary at the time. Stop working for money, make money work for you. Buy assets, avoid liabilities. Think like an investor, not an employee. That message resonated with tens of millions of people. But beyond the book, Kiyosaki has been a vocal, consistent, and often early voice on precious metals. He bought his first silver in 1965 at 18 years old, when silver cost literal cents per ounce. He has been adding to his position for more than 50 years. He is not someone who discovered silver last year because it was trending on social media. He is someone who has lived through multiple precious metals cycles, multiple financial crises, and multiple periods of dollar weakness, and has consistently come back to the same conclusion: silver is one of the most undervalued assets on the planet. That context matters when you evaluate his $200 prediction. Let me be precise here because I think it's important to represent his views accurately rather than either overhyping or dismissing them. Kiyosaki's $200 silver call has been made across multiple posts and interviews over the past year. His core argument, stated in his own words, is this: in today's technology age, silver is elevated into an economic structural metal, much like iron was the structural metal of the industrial age. He is making the case that silver's role in the modern economy has fundamentally changed. It is no longer just a monetary metal or a jewelry metal. It is now an industrial backbone. Solar panels, electric vehicles, AI servers, medical devices, military equipment, all of these require silver. And unlike gold, which sits in vaults and gets recycled indefinitely, silver gets consumed. It gets used up in industrial processes that make recovery difficult and expensive. Kiyosaki's point is simple. The world needs more silver every year, mining production is not keeping up, and the price has nowhere to go but up. His most recent statement, posted on May 11th, 2026, called silver one of the best investments I own, reinforcing that even at $86 per ounce, he has not changed his long-term view. Here's what I find genuinely compelling about Kiyosaki's silver calls, and it's not the boldness of the numbers, it's the track record. In November 2025, Kiyosaki predicted silver would reach $100 per ounce in 2026. At the time, silver was trading near $70. Most mainstream analysts called it aggressive. Silver hit $100 in February 2026, just 3 months later. Before that, when silver was trading under $30, Kiyosaki publicly predicted it would break through $50, its previous all-time high from 1980. Most people thought that was impossible. Silver broke $50 in October 2025 for the first time in 45 years, then went on to reach $72 by year-end, a gain of roughly 150% for the year. He also predicted in 2024 that silver would reach $70 before end of 2025. It did. So when we ask the question, is $200 really happening? We should at minimum acknowledge that this is a person who has been directionally correct on silver at multiple major milestones. His timing has sometimes been early. His direction has been right. That is a meaningful track record that deserves respect, even from skeptics. Now let's get into the actual substance of why Kiyosaki believes silver is going to $200, because it's not just a feeling or a gut instinct. He has a specific macro thesis that underlies the prediction. Kiyosaki's central argument is about the US dollar. He has been warning for years that the dollar is in structural decline, that the combination of $39 trillion in national debt, relentless money printing, and the erosion of global confidence in dollar-denominated assets is creating a slow-motion crisis that will ultimately destroy the purchasing power of paper money. His argument is not new. In fact, he has been making this argument since at least 2002 in his book, Rich Dad's Prophecy. What is new is that the conditions he described back then are now visibly playing out. Central banks around the world, particularly in China, India, and emerging markets, have been buying gold and silver at record pace, explicitly diversifying away from dollar reserves. The BRICS nations are actively working to reduce dollar dependency in international trade, and the United States itself continues to spend far beyond its means, adding to a debt load that mathematically cannot be repaid in real terms. In this environment, Kiyosaki argues, the question is not whether hard assets like silver will rise, it is how high they will go before the system resets. But Kiyosaki's $200 target is not purely a monetary argument. It is equally, perhaps even more so, an industrial argument, and this is where his case gets genuinely interesting. He has been explicit that silver's role in technology is what elevates it above gold in the current environment. Let me put some real numbers on this. The solar industry alone consumed an estimated 232 million ounces of silver in 2025, up significantly from 140 million ounces in 2022. That growth rate is accelerating, not decelerating. Countries across Asia, Europe, and North America are installing solar capacity at record pace to meet clean energy targets. Each panel requires silver. It cannot be replaced with another metal without significant loss of efficiency. Electric vehicles are adding another layer of demand. Each EV contains roughly 1 to 2 ounces of silver in its electronics, charging components, and battery management systems. Global EV production is scaling rapidly, with projections of tens of millions of units annually by the late 2020s. And then there is AI. Data centers being built to power the artificial intelligence revolution require electronics, and those electronics require silver. The AI infrastructure build-out is happening right now in 2026, and it is adding millions of ounces of incremental silver demand to a market that was already running a structural deficit. This is the industrial demand case that Kiyosaki is pointing to, and it is real, verifiable, and growing. Now here's the other half of the equation, supply. And this is where the math becomes genuinely uncomfortable for anyone who thinks silver is overpriced. Global silver mine production has been essentially flat for several years. The Silver Institute, the most authoritative research body on the silver market, projects total mine supply in 2026 of approximately 844 million ounces. Total demand, including industrial, investment, and jewelry consumption, is projected at over 1.2 billion ounces. That is a deficit of roughly 46 million ounces. But here's the part that does not get discussed enough. Even if silver miners wanted to ramp up production dramatically in response to higher prices, they cannot do it quickly. New mine development takes 10 to 15 years from initial discovery to first production. Environmental permitting, community consultations, infrastructure development, processing facility construction. Each of these steps takes years. There is no shortcut. The pipeline of new silver projects coming into production over the next 3 to 5 years is thin. The structural deficit will not be resolved by market forces in the near term. It will continue to build. And a market that runs a deficit of 46 million ounces per year, drawing down finite above-ground stockpiles, cannot sustain artificially low prices indefinitely. Kiyosaki understands this. That is part of what drives his $200 conviction. I think it's worth pausing and revisiting what happened in January and February 2026, because the price action during that period tells us something important about how silver behaves when institutional and retail demand collide simultaneously. In January 2026, silver hit an all-time high of $121.88 per ounce. That move happened in a matter of weeks. Before that high was reached, silver had broken through $100, a psychological milestone that Kiyosaki had specifically targeted. At that point, retail buying surged dramatically. Coin dealers and bullion shops in the United States, Europe, and Asia reported waiting lists for physical silver. Online platforms saw order volumes that overwhelmed fulfillment systems. The demand for physical silver was so strong that it briefly created a significant premium. Buyers were paying $8 to $12 above spot price just to get physical metal delivered. Then came the crash, a 36% decline in under 2 weeks. Kiyosaki had actually warned about this. In late December 2025, just before the crash, he wrote, "FOMO, fear of missing out mania crash, is coming. If you are planning on investing in silver, be patient. Wait for a crash, then go." He called the crash before it happened, and his advice, to wait for pullbacks and then buy, reflects the disciplined approach of someone who has navigated multiple volatile precious metal cycles. Let's do the math, because I think it helps ground the discussion in reality rather than emotion. For silver to reach $200 from today's price of approximately $86, it would need to gain roughly 133%. That sounds like a lot. But consider, in 2025 alone, silver gained approximately 150%. It did in 1 year what would need to happen for Kiyosaki's $200 target to materialize. So on a pure percentage basis, a move to $200 is not historically unprecedented. It happened in the last 12 months on a base that was about 60% lower. From the perspective of the gold to silver ratio, if gold stays near its current level of $4,150 and the ratio compresses from 55 to 1 to 24 to 1, which is well within historical precedent for a precious metals bull market peak, silver reaches 197. That is essentially $200. For that to happen, you don't need some extraordinary scenario. You need the ratio to compress to a level it has reached in previous bull markets. That is not a guaranteed outcome, but it is a historically grounded one. Kiyosaki's $200 is bold. It is not absurd. And the math, when you actually run it, is more supportive than most people realize. It's worth being honest about the gap between Kiyosaki's $200 target and where mainstream Wall Street sits on silver. The Reuters poll of 30 institutional analysts has a median silver forecast of around $79 to $85 for 2026. Goldman Sachs expects silver to average $85 to $100. Citigroup has a target of $110 for the second half of 2026. Bank of America, as we discussed in a previous video, has an outlier call of $135 to $309. And Kiyosaki is at $200. So where does that leave us? Wall Street consensus is significantly below Kiyosaki's target. But Wall Street consensus was also significantly below where silver actually traded in 2025. Most institutional forecasts entering 2025 had silver peaking at $35 to $40. It hit $121. The consensus was wrong by a factor of 3. This does not mean Kiyosaki is right. But it does mean that dismissing his view purely because it differs from the institutional consensus is not intellectually honest, given how badly that consensus has already missed in this silver cycle.